Up until a week or two, a few weeks ago, and maybe only for a week or two in when gold was peaking, there were net purchases in the ETFs. But long and short of it is the number of tons of gold held by the exchange traded funds in the West have been kind of falling. So as the price went up, retail investors have been coming out of gold and going into tech stocks. But the gold price keeps going up. So it's not the retail investors who are involved in the market, it's someone else. And now these could be big hedge funds, it could be central banks, it could be the US government itself, we don't know. But there's someone out there who is buying gold at the same time as retail investors are selling it. Why? Who is this buyer? Who are these buyers?
Clive Thompson says central banks, especially China, are quietly buying gold while Western investors sell. He warns AI-driven layoffs will trigger recession and massive money printing, pushing money into hard assets. Banks still avoid gold due to slow internal approvals, but 2026 allocations are likely. Silver remains extremely scarce. Only one in approximately 45 people could own an ounce. His miner model shows how a small gold rise can double profits. Thanks for watching. Subscribe to Fine Metals for more updates.
The other thing we've got coming, and coming with a vengeance, is artificial intelligence. That is going to put hundreds of millions of people around the world out of work. Let's face it, if you have AI and someone in your office can use it, it's going to make that person many times more productive if he knows how to use it well. And AI, from the firm owner's point of view, it doesn't need a desk, it doesn't need a cubicle, it doesn't go to the bathroom taking its telephone with it, it doesn't stand by the coffee machine discussing last night's Netflix, it doesn't ask for pay rises, it doesn't upset the girl in number 42 cubicle, it doesn't take holidays, it doesn't have kids, it doesn't go on sick leave. So the case for having AI efficiency in people's offices is extreme. And that means that virtually every IT department in every large firm will be working to implement IT in the offices, in the front office, where the workers are. And the workers will say, oh, this is great because they're making me more efficient. I can do my job much easier. I can say reply to this email or whatever they do. They're going to make all kinds of things will be easier. But what they don't realize is that some of those people at the front office are going to become better than others at mastering the technology and will be able to do the job of 2 or 3 or more people because of that. And that means less people will be needed. And we're already seeing the first waves of layoffs happening due to AI making the jobs for those who could master it that much easier. And there's a lot more going on that we don't actually see in the headlines. I have a friend who works for one of the largest companies in the world. He's at the Swiss office here. It's a company with several 100,000 employees globally. He tells me that their company at the moment are working on 15% across the board layoffs. They're doing it quietly, they're doing it under the radar screen, but the reality for the reason doing it is artificial intelligence. They're not making any public announcements about it. They're just quietly letting people go a bit here, a bit there, with the target of getting rid of 15% of the labor force within a year and a half.
Right.
And
Yeah.
he personally doesn't even know if he's going to be one of them. But the fact he's working on he's working on part of the task force, but pretty soon they'll find AI perhaps to replace him. So that's going to create a lot of unemployment globally, which does mean recession. Potentially, it means that there's nobody there to buy anything either because they don't have the salaries. Seen a lot more central bank buying in the last few years, and many of the indicators are that some central banks are buying gold and not telling anybody about it. They're doing it covertly. The biggest candidate for that is China, where they have they produce about 20% of the world's gold from their own mines. There's also, and I don't have concrete evidence of this, but there's a lot of people who seem to have done the research and got the evidence. There's also large quantities of 400-ounce bars being exported from Switzerland and the UK to China. And these are not the sort of bars which are used at the Shanghai Stock Exchange, which uses a 1 ounce, 3 ounce, 100-ounce bars, and then 1 kilogram bars, and they're not the sort of bars which are used in the jewelry industry. So these are the sort of bars which are used by central banks for storage. So there's the internal production of coming from China's own gold mines, perhaps 20% of it going into their reserves, secret reserves. We've potentially got a lot of bars moving to China, which we don't know where they're going, but they're the type of bars which would be held by central banks. And then the last thing we've got is since 2014, China's official reserves, which is basically treasury bonds and gold and special drawing rights, the official reserves have plateaued. Now, that's odd when China's trade surpluses have ever since continued to climb every year. Their trade surplus has been climbing, their current account surplus has been climbing. So for decades before that, as this trade surplus was climbing, the reserves would go up. It wasn't a one-for-one match, but more surplus trade means more money in the central bank. Suddenly, it seems to have plateaued since 2014, which kind of implies they're still potentially building up the reserves, but they're not reporting it. So why are they not reporting it? Because perhaps it would hack off the Americans to know they're buying gold. So they are buying a little bit gold. That's officially reported numbers. But the numbers that they're buying, whilst they're pushing up gold as a percentage of their reserves on the balance sheet, it's still looking like it's relatively small. But reality, it's probably quite big. And I expect the central banks around the world, which are also building up reserves. I saw an article saying that there's less central banks now reporting their gold purchases than ever before. Silver has outperformed gold in the current bull market. And I say bull market because I think we're still very much at the early stages of that. So obviously on the industrial side, it's a possibility that the demand will slide a little bit at the higher prices, but that's counteracted by the investor demand, which now wants to buy silver. Now, the Silver Institute is forecasting that investors will buy 200, I think it's 200 million ounces of silver in investment gold this year. When you divide that number out by the population of the planet, you'll find that's one person in 45 or something like that can have 1 ounce. Now, I know half the world probably can't afford anything in silver, but even so, if you think about it, if you have 1 ounce of silver alone, you're already ahead of the other 46 who won't be able to have it because there just isn't enough. If that 200 million ounces figure, that estimate going into investment demand is correct. Now, if that figure turns out to be 400 million ounces, because actually there's more than one person of 47 wants to buy an ounce, or that 1 in 47 persons wants to buy 2 ounces, well, where's it going to come from? The mined output is relatively inelastic, so the only place that extra silver can come from is recycled silver. And the only way you get recycled silver is to have a higher price than yesterday, going back maybe 6 months, but right up to yesterday as well, examining the potential for various gold mining companies. I'm probably looking at 1 or 2 a day. At least this week I was. And the way I do that is I examine how much gold the company is going to produce. We call it gold equivalent ounces, GEO, because they often produce other things like silver. So if they're producing gold and silver, they'll convert the silver into gold equivalent ounces. So you look at how many gold equivalent ounces are going to produce this year, next year, and making a best estimate of what they'll produce the year after, and so on. You've got to take into account the expected life of the mine as well. Then you've got to put on that number of ounces a gold price. And I typically say how many ounces will be produced in 2027 based on everything we can know. And usually you can find this information on the website. They don't usually say the actual number in 2027, but they talk about whether they're increasing production or decreasing it or what their expectations. Often you'll get an estimate for next year, but maybe not 27. But I can make a very good estimate of 2027's gold production, how many ounces. I can put a price on it. I take $5,000 as my price for 2027. It could be higher, could be lower. Then I knock off from that so I know the number of ounces times the gold price gives me a number. That's their total value of their production. Now I knock off from that what's called the all-in sustaining cost, AISC. Now that's a cost which almost every gold mining company on the planet will publish the all-in sustaining cost. It cost us 2,150 to dig it up. We're selling it for 3,500, whatever. You'll have those two numbers for the last year. So the all-in sustaining cost does change depending on the grades they're digging up and depending on how much bigger the mine is or smaller it is, because if you're bigger, you've got more efficiencies and so forth. But broadly speaking, you take the current number, add a little bit for inflation, maybe 10%, and you can get to an all-in sustaining cost per ounce for 2027. So I knock that off. That gives me the gross profit before other expenses. Then we have to deal with other expenses, which is everything else like taxes, like prospecting costs, like marketing, like management, and so on. So you knock off all those other costs, again adjusted according to the changed number of ounces, and you'll get a net profit. Take the net profit, divide it by the number of shares in existence. There's a leveraged effect on the profits when the gold price goes up or down in both directions. So, for example, if you have a gold mining company which is digging gold out of the ground at $2,000 an ounce, that's the cost, the all-in sustaining, and it's selling it for $3,000, its profit is $1,000 an ounce. Okay, now let's suppose that the gold price goes up from $3,000 to $4,000. That's a rise of 33%. But the gold mining company's profit goes up, still digging out at 2,000. It was selling 3, that's 1,000. Now it's selling at 4,000. So the gold mining company's profit doubles from $1,000 an ounce to $2,000 an ounce. So the gold mining company's profit can rise by 100% when the gold price only went up by 33%. So that's your leveraged effect. And the reality here is I think that most gold mining companies are currently looking at a gold price. They're not yet ready to believe it, and the investors aren't ready to believe it. They're looking at a gold price which is back where it was a year and a half ago, $2,500 to $3,000. They're not yet factoring in the extra 1,000 we've had on top of that to 4,000. I wish I knew when I was 18 what I know now. And the number one thing I would say to a young person is if you have a strong conviction and you're young, 20, 21, 22, there's no harm in going all in on your strong conviction. You might lose it all, but it's a great test to see if your conviction is right. And the number of investments you should own, and I tell young people this now, is take your age, deduct the number 20, and that's how many investments you should own. So if you're 21, you're fine owning one investment, all in. If you're 22, now you should have two. If you're 60, you should have 40 investments, because the older you get, the less time you have ahead of you to recover things, and therefore you need to be much more diversified, so that if one of your conviction bets goes wrong, you still have all the others. So, by the time you get to my age, and you should have I'm 68, you should have a minimum of 48 investments, minimum. That doesn't mean say you can't have 100. And some people say, but Clive, that's crazy. How can you monitor 48, let alone 100? Well, I can answer that. Provided that you're convinced of the merits of the investment you're making at the time you make it, That's the last time you should look at it for a very long time.